Balance of payment, midterm. Measuring macroeconomic activity. Accounting concepts. To get the complete picture of the macroeconomic linkages among economies that trade internationally, we must understand two related and essential tools. First of all, the national income accounting. All expenditures that contribute to domestic income and output. Second, balance of payments accounting. All transactions between the domestic and foreign economies. G&E. Expenditure on final goods and services by home consumers, businesses, and the government. GDP. Value of final production of home firms. G&I. Firms pay the income to the factors of production, which includes labor, capital, and land. International transactions are recorded in the balance of payments. It has three components. First, current account, which includes the trade balance, net factor income from abroad, and net unilateral transfers. Second, financial account. Third, capital account. Transfer of non-financial, non-produced assets, for example, trademarks, copyrights. The current account is the sum of three accounts: the trade balance plus net factor income from abroad plus net unilateral transfers. TB accounts for difference between G&E and GDP. NFIA accounts for difference between GDP and G&I. NUT account for difference between G&I and GNDI. Together, the CA gives the difference between G&E and GNDI. The trade balance measures the difference between exports of goods and services and imports of goods and services. Examples of internationally traded goods are textiles, oil, and cars. Examples of internationally traded services are education, medical care, and consulting. GDP is the value of all final goods and services produced within a country. The trade balance is also called net exports. If the trade balance is larger than zero, exports are larger than imports, which equals a trade surplus. If the trade balance is smaller than zero, exports are smaller than imports, which equals a trade deficit. Net factor income from abroad, NFIA, is the difference between factor incomes received from and paid to the rest of the world. For example, a US-owned company in Ireland generates profits for their US owners. Net unilateral transfers, NUT. Difference between gifts received from the rest of the world and gifts given to the rest of the world. Example, foreign aid by governments. The CA tells us whether a country is spending more or less than its income. The LHS is national saving, which tells us how much of national production is consumed by domestic households and the government. A CA deficit measures how much a country saves too little relative to its investment needs. This explains the widespread use of a CA deficit in the media as a measure of how a country spends more than it earns or is living beyond its means. The financial account, FA, summarizes international transactions in financial assets, for example, stocks, government debt, and real assets such as factory. The FA records all movements of financial assets across international borders, mostly movement of ownership. When domestic output is larger than domestic expenditure, In other words, export is larger than import, or trade balance is larger than zero, or CA is larger than zero, the country receives more income from exports than it spends on imports. The country is a net lender to the rest of the world, for example, Germany. The other way around. When the domestic output is smaller than the domestic expenditure, or the export is smaller than the imports, or the trade balance is smaller than zero, and the CA is smaller than zero, the country receives less income from exports than it spends on imports. The country is a net borrower from the rest of the world, for example, the US. An important measure is a country's external wealth, W. The difference of all assets owned abroad minus all liabilities owed to foreigners. All else equal, W increases when the CA is positive and decreases when the CA is negative. The CA is a flow, the W is a stock. A country with a CA deficit is importing current consumption and exporting future consumption. Summary of Chapter 1. If the exports are larger than the imports, the country is a net lender. If the exports are smaller than the imports, the country is a net borrower. The sum of lending and borrowing over time gives a country's external wealth. Exchange rate basics. Defining the exchange rate. An exchange rate is the price of a currency in terms of another currency. There are two equivalent ways to quote this price: the quantity quotation and the price quotation. The quantity quotation: number of foreign currency units for 1 unit of home currency. The price quotation: number of home currency units for 1 unit of foreign currency. Appreciation and depreciation. Appreciation of euro. 1 euro buys more of another currency. We say the euro has risen, appreciated, or strengthened. Depreciation of euro. 1 euro buys less of another currency. We say the euro has fallen, depreciated, or weakened. Effective exchange rates. The rate between two countries is called bilateral exchange rate, but countries trade with many partners at the same time. The effective exchange rate uses trade weights to construct an average of the bilateral rates. The FX market. The FX or Forex market is not a single organized market. Trade between two parties take place over the counter, OTC. Supply and demand for each currency determine their price. The Forex market is massive. In 2019, $6.6 trillion of currency were traded per day, which is 15 times the entire annual economic output of Austria. The largest trading places in order of importance are London, New York, Singapore, Hong Kong, and Tokyo. The top traders are the Deutsche Bank, UBS, JP Morgan, and many more. The main types of FX contracts are the spot, where is an immediate exchange of two currencies on the spot. The forward, future delivery at price agreed today. Typical maturities are 1 week, 30 days, 90 days, and rarely more than a year. The swap combines spot sale and forward repurchase of a currency. It has lower fees than on two separate contracts. Motivations for forwards and swaps. The insurance, hedging FX risk of cross-border trade or financial transactions. The arbitrage, exploiting existing spread differences across marketplaces. Speculation, exploiting perceived profit opportunities. Central bank actions on the FX market. The capital controls try to stop or substantially limit cross-border transactions and force or prevent conversion of currencies. It typically leads to creation of black markets. The reserve intervention try to fix forex prices through market forces of supply or demand. Arbitrage and spot rates. The key concept of international economics is arbitrage. Traders will exploit any small profit opportunity arising from existing price differences, buy low and sell high. For example, suppose the exchange rate in New York is 1.1 euros per US dollar and in Frankfurt it is 1.2 euros per US dollar. Is a profit possible? Yes, of course. Buy 1 US dollar for 1.1 euros in New York and sell it for 1.2 euros in Frankfurt, which equals a riskless profit. Everyone will buy US dollars in New York and sell them in Frankfurt. This would bid up the spot rate in New York and bid down the spot rate in Frankfurt. This process will continue until the prices convert, the arbitrage opportunity vanishes, and so equilibrium is reached. In general, one of three outcomes can occur in the forex market. The spot rate is higher in New York, the spot rate is higher in Frankfurt, or the spot rates equal in New York and Frankfurt. No arbitrage condition for spot rate is the equality. Vehicle currencies. The same logic for arbitrage between two currencies can also be applied to three currencies or even more. For example, one might realize a profit by exchanging US dollar into euros and then euros into pounds. In fact, the vast majority of currencies does only trade directly with one or two of the major currencies. When a third currency is used in transactions, it is called a vehicle currency. Arbitrage and interest rates. An important question for investors is in which currency to hold their liquid cash balances. For example, a trader working for a New York balance could leave the bank's cash in a yen deposit or in a US dollar deposit. Interest rate differentials between currencies can be substantial. Would it make sense for a US trader in New York to sell dollar and buy pound to invest in the UK for 1 year? The key issue is exchange rate risk. The trader is in New York and her bank cares about returns in US dollars. But US investment pays a certain US dollar return, but UK investment pays return in pounds. The exchange rate in 1 year is uncertain. The trader has two options. Hedge the exposure to exchange rate risk by using a forward contract, which is covered interest parity minus riskless arbitrage, or do not use a forward, rather wait and use a spot contract in 1 year, which is uncovered interest parity minus risky. Covered interest parity. Riskless arbitrage. We are starting with an example. Suppose you are trading in New York. Home currency is dollar. Suppose the forward exchange rate agreed today to exchange euros for US dollar in 1 year is F USD per euro. After completing all the calculations, there are 3 possible outcomes. The US deposit has a higher dollar return, the euro deposit has a higher dollar return, or both deposits have the same dollar return. Only when both deposits have the same dollar return are there no profits from arbitrage. Let's take a look at the covered interest parity formula. What if equality didn't hold? Suppose LHS is smaller than RHS. Given E dollar per euro, no investor would want to hold USD deposits, and all investors would want to hold euro deposits. Demand rises for forward contracts to exchange euro against dollar in 1 year. The forward exchange rate of USD per euro would decrease, decreasing the right side until equality was achieved. In fact, we can use the CIP to determine the forward exchange rate. Let's take another look at the formula. The CIP is a no arbitrage condition that describes an equilibrium in which investors are indifferent between investing domestically or abroad. Let's take a look at the 12-month interest rate calculation in the Zusammenfassung. In practice, this is how the FX market mostly works and how F is set. But instead of using a spot and forward contract, a single swap would be used. If we take a look at the evidence on CIP, we can make the assumption that CIP can be violated when arbitrage is not possible. Uncovered interest parity. A second way to exploit interest rate differentials is to use spot contracts instead of forwards and accepting the exchange rate risk. For the example, you should take a look at the Zusammenfassung. There are again 3 possible outcomes. The US deposit has a higher expected dollar return, the euro deposit has a higher expected dollar return, and both deposits have the same expected dollar return. Only when both deposits have the same expected dollar return are there no profits from interest rate differentials. For the rest, you should take a look at the Zusammenfassung because they are mainly calculations and I have no gusto. Interest rates in the short run. The UIP tells us how the spot exchange rate is determined for a given expected exchange rate and nominal interest rates. Example: we assume that nominal prices are rigged in the short run. This might be due to, for example, menu costs. We also assume that the money supply is controlled by the central bank. The money market equilibrium is real money supply equals real money demand. FX market and money market equilibrium. Capital mobility is crucial. Only with arbitrage on the FX market will UIP hold. In this case, DR equals FR. If a country imposes capital controls, there is no arbitrage, and DR unequals FR might persist for some time. Summary of chapter. Interest rate differentials can be large and persistent, and currencies might be expected to depreciate or appreciate. The monetary policies of the domestic and foreign central banks can determine nominal interest rates at home and abroad. Investors will shift funds from one country to another, until the expected rates of return, measured in a common currency, are equal. Arbitrage in the FX market determines the spot exchange rate, and the FX market is in equilibrium when UIP holds. The law of one price loop. Arbitrage does not only occur in international financial markets, but also in the international goods market. If the price of a good is not the same in two locations when measured in a common currency, buyers will rush to buy in the cheaper location, forcing prices up there, and avoid buying in the expensive location, forcing prices down there. Under certain conditions, tradable goods sold in the different locations must sell for the same price when expressed in a common currency. The conditions are an absence of trade frictions like transport costs and tariffs, or competitive markets such that supply and demand determine prices. We will skip the examples and the calculations and will take a look at the findings and why the Big Mac experiment failed. Some price components are not tradable, like labor, rent, electricity, etc. Types of goods which the loop holds pretty well are commodities, like gold, oil, or luxury consumer goods, like Rolex watches. They are tradable and standardized goods. Type of goods which the loop doesn't hold well are personal services like healthcare, education, restaurant meals, etc. Also housing, transportation, and utilities. These are non-tradable goods and services. Absolute purchasing power parity, triple P, is the generalization of the idea of the loop to a basket of goods. The price level P in each location is the weighted average of prices of all goods in a basket, using the same goods and weights in every location. If the loop holds for each good in the basket, it would also hold for the price of the basket as a whole. If we take a look at the formula of the real exchange rate, it can be stated that it measures how many US baskets of goods are needed to buy one European basket of goods. When Q equals 1, we say that absolute triple P holds. If the real exchange rate rises, more domestic baskets needed to buy one foreign basket, we say the home economy has experienced a real depreciation. The other way around, if the real exchange rate falls, less domestic baskets needed to buy one foreign basket, we say the home economy has experienced a real appreciation. If the real exchange rate is above 1, then the US basket is relatively cheap. We say the USD is undervalued against the euro. Example: if the European basket costs 550 in USD and the US basket costs 500, then the real exchange rate equals 1.1. The USD is 10% undervalued against the euro. Relative triple P. Absolute triple P involves price levels, but in macroeconomics we often mostly interested in the rate of price changes, the rate of inflation. Relative triple P translates absolute triple P from a statement about price and exchange rate levels into one about price and exchange changes. Relative triple P is derived from absolute triple P. Summary of the chapter. The real exchange rate says how many domestic baskets of goods can be exchanged for one foreign basket. When a country is expected to have persistently higher inflation rate than the rest of the world, its currency is expected to depreciate in the future. The evidence suggests that the relative triple P is a useful approach to understand long-run exchange rate movement.